Right. So we're going to go over, a couple of different concepts here, a few different concepts. First, we're going to talk about turnover basics. Then we're going to talk about the specifics between HOA turnover and condo turnover. And then we're going to talk about developer obligations. Then we're going to get into the documents themselves. What documents do you get at turnover? Then we're going to talk about developer contracts, and then things to consider post turnover. So when you've got turnover and you're in that first, few months as operating as a board, what do you do at that point in time? Or what should you do at that point in time? Probably is a better way of saying it. All right, so what is turnover? Turnover is the transfer of association control from developers to non-developer owners. And you see there's a citation right behind that. That's FAC, that's the Florida Administrative Code 61B-22.0016. And so that's where the definition of the term turnover is found. And so just from, understanding how really HOA and condo law works, we've got a framework that's really set by our documents. So, your declaration is your main document, your recorded document that tells you really all the rules of the association. And then those are buttressed by Florida statutes. Chapter 720 governs homeowner associations, and Chapter 718 governs condo associations. And then the Florida Administrative Code is not the law, but that is, interpretation of the statutes, the 718 and the 720. And so if you've got, a term sometimes like turnover, which is not specifically defined in the statutes, it's defined in the administrative code because it was something that the Department of Division of Corporation, not corporations, Division of Condominiums and Associations, they thought was important. All right, so who's a developer? Developer is the person or the entity that creates a condominium or offers a condominium or HOA parcels for sale or lease. And so a developer, when you go to operate an HOA, it's a lot more simple to develop an HOA than it is to develop a condominium. If you're developing an HOA, you basically just have to, put together your PUD, and you have to, you just have to put together your PUD, and you have to record your HOA documents. With a condominium, you've got to submit all your documents to the Division of Condominiums, and those have to be approved. So there has to be a prospectus and approval by the department. The Department of Business and Professional Regulation regulates the condominiums, developers, community association managers, and HOAs. The DBPR division specifically involved is the Division of Florida Condominiums, Timeshares, and Mobile Homes. So all the CAMs that are on the call today, they're all regulated by the DBPR, and the condominiums are as well. With the condominiums, some of the disputes that arise out of condominiums are, governed by or regulated by mandatory, binding arbitration. And after some of the matters are arbitrated, if the parties aren't happy with the result, they can essentially appeal to, a court of law. All right, so the statute that is specifically governed, that specifically governs HOA turnover is 720.307. And so members other than the developer are entitled to elect at least a majority of the members of the board upon the occurrence of certain events, which we'll go over in just a second here. And those events are once 90% of the parcels in all phases of the community have been conveyed to members, been sold, then 3 months after that, the HOA is entitled to elect a majority of the board members. Another such occurrence is when the parcels have been conveyed to members or such other date or event has occurred as is set forth in the HOA's governing documents, so pursuant to the documents themselves. If the developer abandons the property, then at that point in time, the members of the association, the non-developer members, are entitled to control a majority of the positions. If the developer files bankruptcy, if the developer loses title to a foreclosure, and then if a receiver is appointed for any reason and not discharged within 30 days, those are all situations that mandate control of the association essentially by the non-developer unit owners, at least a control of a majority of the positions. All right, so developers and owners have certain rights to minority representation on the HOA board of directors. And so members other than the developer are entitled to elect at least one member of the board of directors if 50% of all of the parcels in the phases of the community have been conveyed to members. So if you've got an association that is, basically 50% built out and sold, at that point in time, the non-developer unit owners are entitled to at least one member on the board of directors. That's a right that is, often not asserted because, simply put, the developer just doesn't typically get around to it unless the non-developer member owners are going to enforce that right. It's not a right that you often see exercised. And then developers are entitled to at least one member on the board so long as they hold at least 5% of the parcels in all phases of the community. So I mean, that's a right that's enforced a lot more frequently than the other. So the non-developer member owners typically don't exercise their right to have at least one member of the board, primarily because they don't know they have that right. The developer, obviously being experienced in the process, understands what they have and what rights they have. And although that doesn't seem like a real valuable right to have one member sit on a board, since you're not going to really be able to accomplish anything just by a vote, on your own, it's important for a lot of different reasons. Most importantly, it lets the developer know, what's going on, so they get to participate in all the meetings and all the attorney-client meetings and things of that nature. So, really the main reason for the developer to exercise that right is simply, a control aspect, not necessarily control of the association, but, some control over the information so they know what's happening. One of the things a lot of people don't realize is after turnover, the developer may still exercise the right to vote any developer-owned voting interest in the same manner as any other member, except for the purposes of reacquiring control of the HOA. So, just think of it from this perspective, especially if you've got a failed community or, you have a situation where turnover had occurred where the developer still owns a large number of either units, unbuilt or otherwise, in a condominium, or parcels, unbuilt or otherwise, in a community. The HOA can vote just like they would on anything that requires a membership vote. They just don't have the ability or the right to acquire control of the HOA. So if they've got enough votes, they could potentially, do a lot of different things, including amend the declarations and the governing documents. All right, condominium turnover is controlled by section 718.301. And so we just spoke about HOA turnover. Now we're going to talk about condominium turnover. They're a little bit different. The main thing that's different, about condominium turnover and HOA turnover is just, the property and the difference between condo ownership versus homeowner ownership. Condominium ownership is different in that, think of it as a condominium owner owns their however many units are, let's say 100, 1/100th of all of the property within the condominium. So if you're talking about assets like common elements, you own 1/100th of those common elements, and then you own generally from the drywall in, on your unit. Whereas HOA, so you don't own any dirt, for lack of a better term, or the dirt that you do own, you own in a proportionate share with all other condominium unit owners. An HOA, you own a traditional lot, and you own your house, and then it's actually the association that owns the assets, the common elements like the pool and things of that nature. And in your standard setup, you may have, a CDE or something like that that might own the primary assets, and you just have rights to use them or access to use them. But in your standard HOA, that you're going to own your house, and then your association is going to own all of the common elements. So in a condominium association, when non-developer owners own more than 15% of the condominium units, you're entitled to elect at least 1/3 of the board members. So this isn't turnover, and it doesn't give you really a whole lot of power because it's just 1/3, and the non-developer unit owners aren't going to be able to outvote the developer owners. And like I said, you see on the condo board, this being exercised a lot more, than the rights on the HOA board, and probably because they're maybe more clearly defined in the statutes. But what that gives the non-developer unit owners an opportunity to do is just like, I was talking about with the developers. It gives you an opportunity to sit on the board, to listen, to participate in all the meetings, the attorney-client meetings. And so it gives you an opportunity to control, not necessarily what's happening, but at least information. That's important. And that will also, as you see what's going on, that'll help if those board members become the first turnover board or the first board after turnover. They help you give a better understanding about what's going on, especially with your vendors, and the contracts that you have with your management companies and things of that nature. All right, so majority board representation. And so when does this happen? Non-developer unit owners are entitled to elect a majority of the board members upon the first to occur of any of the following events. 3 years after 50% of the units have been conveyed to the purchasers. 3 months after 90% of the units have been conveyed to purchasers. When all of the units have been completed, some of them have been conveyed to purchasers and none of the remaining units are being offered for sale. And then when some of the units have been conveyed to purchasers and none of the other units are being constructed or offered for sale for business, or when the developer files bankruptcy. So it's similar to what we saw in the condo association. The bottom three, issues that you have here, when the units have been completed but they're not being offered for sale, that's like that's simply or similar to an abandonment principle. When the developer files bankruptcy, so that makes sense. And then, once 50% of the units have been conveyed to purchasers, 3 years after that. So that's a little bit different than in the HOA statute, as it gives some, time frame, as far as when the condo association, has to, have the ability to elect a majority of board members. So the condo can't, stay in development in perpetuity. And then when you have 3 months after 90% of the units have been conveyed to the purchasers, then the non-developer unit owners have a majority control of the board. So this is unlike your 1/3. This is your turnover situations that you have here, and there's some additional events too that are on the next screen. Again, if a receiver is appointed and not discharged in 30 days, or 7 years after the date of recording of the certificate of a surveyor and mapper, or the recording of an instrument that transfers title to a unit which is not accompanied by a recorded assignment. And so the 7 years issue is what I've had most experience with. And so hopefully when you're going through turnover, you're in a situation where you've had a successful project. The developer, hopefully, was in the construction, timely built the units, and was able to sell them and move on. That's what the developer wants. That's what the association members want. But sometimes you get a situation, particularly, like we saw in 2008, where there's a market downturn, where things don't sell, and you have a situation in which 7 years passes from that recording, and you still don't have even 50% of the units turned over. And so what happens in that situation? Well, I mean, there has to be turnover at that point. I'm going to go back one slide. So you have to at that point in time have turnover to the developer, but the developer, if it's been a project that wasn't all that successful, might one not be that willing or have much desire to turn over, or two, they might just not even have their act together enough to get anything done. And so what happens at that point when the developer doesn't go through and turn things over? Well, the developer at that point, or the members of the association at that point in time, can call a meeting for turnover themselves. They don't have to wait on the developer to do that. And so, they can trigger the turnover and they can start the process themselves. Now, even after turnover, the developer relinquishes technical control of the association. So they're not in control of the association anymore, but there's been a new board that's been elected, and those board members are non-developer unit owners. The developers, they still have the right to exercise, votes in the same manner as any other member, except for reacquiring control of the association. So same exact situation that we had spoken about with the HOAs. The developer can still potentially seek to amend documents if they've got enough votes to do that, and it's within their right to do that. In fact, developers often do that if it's a failed project and they still have a large portion of the units that weren't sold. All right, so as we just spoken about, we've got the meeting to elect the non-developer board members. And so that happens within 75 days after the non-developer unit owners are entitled to elect a member or members of the board. The association, so the developer, is to call and give at least 60 days notice of an election for the members to the board. And so they're going to set up an annual, this is the first annual meeting. They're going to notice the annual meeting just like they would otherwise. And that'll give everyone an opportunity to, in the condo situation, to submit their nominations or not nominate others. And if the association doesn't do that, then the unit owners, can do that on their own. And then upon election of the first non-developer unit owner, the developer shall forward to the DBPR the names and mailing addresses of the unit owner board members. So after you've got that first turnover board, it's the association that is supposed to, turn that information over. Now, in my practice, whether it's a failed community or whether it's a community that's been really successful, you don't get a whole lot of help from the developer at this point. So it's usually a little bit of pulling teeth. I don't know if I've been involved in a situation where every single, and we'll talk about what has to be turned over, in just a few minutes here. But I don't know if I've ever been in a situation where every single document's ever, been provided to me, upon, the first request. It would be nice if all of the documents were provided by the developer, in a nice, neat little package, and you were able to just, move on and operate as, you want to. But the truth of the matter is the developer's probably not making any more money on this condo at this point in time. If it was a successful project, then they've sold almost all their units. They don't care so much about typically making sure that all the documents have been turned over properly. They're ready to close the books on this particular project and move on to the next. If it's a project that wasn't all that successful, then you've got a situation where they probably have, lost money, and they're not looking to, spend additional money on turnover documents or, paying anybody to, make sure that that turnover occurs. And secondly, they're probably not all that interested in, they're more interested in trying to figure out what they're going to do to protect themselves, in a situation, with a project where they don't even have control over it anymore. So they're going to be, concerned about, assessments and things of that nature that, the association, may assess against either phantom units, which is what we call unbuilt condominium units, or potentially assessments to, either unbuilt lots, or developed lots, in an HOA. There also might be some significant planning about what to do. In condominiums, in particular, if you've got a project that wasn't successful, a lot of times the condominiums are done in phases, and so you might have a condominium that when it's submitted to when the declaration is submitted to the division, it indicates there's 5 phases or 3 phases or however many phases. And so what that means is that only the number of units that have elected into the project are part of the condominium. And although the condominium may have contemplated, say, 5 phases with 100 condos each, if they only develop 2 phases and only 100, meaning there's only 200, units that are part of the association, you've got these 3 other phases, which are potentially 300 other units, and you got to figure out what's supposed to happen with those. And so, sometimes, especially if you've got a bankruptcy or if you've got a completely failed project where they're looking for another developer to step in, sometimes that new developer doesn't see things the way that the initial developer saw. So that new developer may, in a phase out, for instance, may elect into the condominium association. So in the example that I gave with 5 phases, 100 units, all, those 3 other phases may elect in one, and or they may decide that they don't want to elect in. So maybe you have a situation where, you have this property that everybody contemplated was going to be additional condos, but maybe the developer develops them as, townhouses, or maybe they develop them as single family homes. And so, those can be some complicated situations where you might have, maybe a different association. If they never did elect in, they create their own association, and they might have rights to use certain roads and things of that nature. And you have to figure out, how these, developments are going to live together but separate, meaning, they're going to submit their own assessments. They may not be part of the association, the condominium association. And there might be, need to be cost sharing agreements and things of that nature if both of the associations are going to be using the same amenities. So, I tell you that just to let you know that there's a lot of things that happen at turnover. And, if you're turning over at any time other than full development of the project, you probably need to have somebody with some experience help you as a board member and as a CAM, walk through what to do with that, because you want to have as much control over what's going to happen with those undeveloped parcels or units as possible. And you want to try to work with the association or the developer. I'm sorry, not the association, but work with the developer as much as possible, so that you can, try to make sure that, things, run smoothly. All right, so one of the things that we talked about was abandonment. So one of the things that causes turnover is abandonment. And as long as if the developer is not holding units for sale in the ordinary course of business, they've been considered to have abandoned the property, and that should trigger turnover. Now, there can be some disagreements about what abandonment is and what abandonment isn't. And we had talked about 2008, just a few minutes ago, and so that, at least in my experience, has been the time that had the most likelihood of a dispute on this particular issue. You know, an association, a developer is not going to want to trigger turnover for abandonment, because the last thing a developer wants is to lose control over their project. It's extremely important for a developer to have control of the association, control of of the funds that the association receives, and as much control over their project as possible. And so if they run into a situation where units just aren't selling, they've got to decide as a developer what they're going to do, and they may have the ability to hit the pause button and just not offer anything for sale for a period of time, so that they can try to wait out a bad market or whatever, because the other thing they don't want to have to do is sell their units at a depressed price. And so, as you can imagine, in 2008, lots of disagreements about that. Developers wanted to sit on the units for as long as possible before they re-offered them for sale, because they just weren't selling and they didn't want to have to lower the prices. And then secondly, the developer, and secondly, is the non-developer unit owners have to understand that abandonment can trigger turnover. And so if you've got a situation where you haven't reached any of the other triggering factors for turnover, but there hasn't been a unit that's been for sale for a while, you can take a look at this provision of the documents and see what that can get you as far as asserting that turnover's been already occurred or should have already occurred. So what is offering units in the ordinary course of business? Because if they're not offering units in the ordinary course of business, then they're abandoned, and that should trigger turnover. And so what has been found to be offering units in the ordinary course of business is if you offer more than 7 units for condominiums comprised of less than 70 units, where that person offers more than 5 units for sale within a 1-year period, or participating in a common promotional plan that offers more than 7 units within a 1-year period. So essentially 10% of the units offered for sale within a 1-year period has typically been considered to be offering units in the ordinary course of business. The other thing that's important for a developer are the assessments themselves. And so, a developer prior to turnover will oftentimes not pay the full assessment that the other unit owners pay. So a developer, if you think about not just the built units, the units that are built that aren't sold yet, but also the unbuilt units. So those are units that have been declared as part of the condominium but not yet built yet. We call them phantom units, is what we typically call them. The developer is not going to want to pay assessments on their unsold or the unbuilt units. And how do they avoid doing that? The primary way that they avoid doing that is by ensuring that that the developer deficit funds the project, meaning that if there's a 500 unit condominium that's only built, say, one building of 20 units, how does the developer avoid paying assessments on those other 480 unbuilt units? Well, as long as they're deficit funding, so they set their budget, their assessment budget, those 20 non-developer unit owners in my example are going to pay their assessments every month, which goes towards the budget. And if there's a budget shortfall, on the common elements and common expenses, then the developer has to make that up. And make in deficit fund is what we call it. So it's one of the reasons why the developers want to keep control of the project for as long as possible. Is they want to control the assessments, they want to control their ability to deficit fund instead of having to pay assessments on all of the units, even the unbuilt units. And so one other thing that we have here is if the developer holds units for sale in the ordinary course of business, then assessments of the developers as a unit owner are only appropriate for capital improvements only. And so, that's important to a developer to make sure that they control, that as much as possible. So we just talked about deficit funding, and so that's called the developer guarantee, and that's governed by statute 718.1169A. And so, and obviously this is in the condominium statute. And so what does this statute say? What does the statute mean? It says that a developer may guarantee to all owners that assessments will not exceed a stated dollar amount for a period of time. So the developer pursuant to the statute can say, hey, look, this is a cap. This is the most your assessments are going to be for X period of time, through turnover, for instance, through a specific date. If the declaration allows it, a developer that's offering units for sale may elect to be excused from payment assessments against those unsold units for a stated period of time after the declaration is recorded. So we had just spoken about that. That's one of the most important provisions to a developer, and virtually every developer takes advantage of that. Like I said in my example, where there's 500 units, 20 units are built, the rest of the units and sold, and the rest of the units haven't been built yet. The developer doesn't want to have to pay the monthly assessment times 480 units in that example. It's cost prohibitive for them to do that. It's in their best interest to make sure that the amenities are nice and well taken care of, because if the amenities aren't looking spick and span, they're not selling any units. And so as long as the developer is deficit funding, making, paying for all of the maintenance, all of the budget shortfalls, and as long as their declaration allows them to do that, then they're excused from payment of those assessments at that point in time. The other thing that they do, as we had said before, is that if it's a big condominium project, they're probably going to do it in phase out. So in my 500 example, we had talked about 5 phases, 100 units per phase. And so that gives the developer yet another layer of protection on these assessments, because even if they had a situation where turnover was mandated because 7 years had passed, and since the recording, at that point you're only going to have turnover on the declared phases. So if they've only built 100 and they didn't declare their other phases, that means that those potential condominiums, are not, part of the condominium project, and it means that the developer, caps their, assessment liability. So even if they didn't build out even all of the first phase, they would make sure that they would never have to pay more than the assessments on 100 units, whether built or unbuilt. Down in the third little box here, though, however, the developers got to pay those common expenses that we talked about. They've got a deficit fund during that period. And so if the expenses exceed the regular periodic assessments that are obtained by the non-developer unit owners, the developer has to make up that, and that includes any reserves if they're not waived. That being said, developers almost always waive reserves. We'll talk about, and just to, I guess I'll talk about it a little bit now, and we can finish up with it later, but you've got two separate buckets of money, essentially, in either an HOA or a condo association. In an HOA, you've got to actually declare reserves. You got to create your reserve fund. And then in a condo association, there's one automatically present, or you have to automatically reserve unless you waive those rights. And so, think about, your budget, your annual assessments as just being your general fund, your general kitty that your assessments go into, and those assessments can be used for any proper purpose. Anything that the association may need, whether it is paying CAM fees, management fees, whether it's paying for irrigation, or whether it's paying for, let's say, not necessarily improvements to buildings, but improvements to landscaping and things of that nature, and can be used, to improve buildings as well. In both a condominium and in an HOA, if you set up a reserve account, then you have to obtain a reserve study. And a reserve study is a document that tells you what essentially the useful life is on different components, different things that are owned by either the condo or the homeowners association, and then what the replacement cost is for that. So example is if you reserve for a building and you have a specific reserve for a roof, then it would state, well, this is a brand new roof, life expectancy of this roof is 20 years, and so the replacement costs for the roof are X dollars. And then you'll have the reserve study will be put together and will provide you with the amount of money that you should put aside for the roof on an annual basis, so that when that 20 years gets here, you have money already set aside to expend on the roof. And so, the good thing about that is it helps you put money aside for specific purposes. If there's a con to it, it limits you on what you can expend. So if the association has a large amount of money in their reserve account, and they need to spend that money on something other than what it's reserved for, they simply can't do that. And so you can fully fund your reserves, meaning that you intend to make sure that when you get to that useful life period, you've got all the money necessary to make the replacement, or you can partially reserve, and that's generally up to the board to determine that. So going back to this guarantee period, and so unless reserves are waived, or in an HOA, if their reserves are created, the developer, has to, include the funding of the reserves as well. So if the association's not, so if the association has a budget shortfall on their reserve funds, the developer, unless they waived it, would have to make those additional payments into the reserves, which, as I said, most developers are savvy enough to waive that reserve so that they don't have additional funds that they have to pay into to essentially help replace a roof or paint or whatever else might be reserved for it, as far as building maintenance goes, or amenity maintenance as well. So pursuant to administrative code, the guarantee period has to have a beginning date and an end date. And the period has to be the same for all owners within a condominium, but it can vary for each condominium that's operated in within a multi-condominium. All right, so the first bullet point that we have here is talking about the phantom units again. It says a developer who owns units and offers units for sale may be excused from payment of assessments on those unsold units for the period of time the developer has guaranteed to all owners that assessments will not exceed a stated dollar amount, and that the developer will pay any common expenses that exceed that guaranteed amount. And so, again, as long as the developer is deficit funding, if they're doing their guarantee, as long as they've got their guarantee in place, they're not going to have to pay assessments on either the units that are built and not sold, or perhaps even on the units that haven't even been developed yet. And so that's a tough concept to kind of grasp, that phantom unit concept. But that's obviously a really big deal to developers, as they would much rather deficit fund and then have to pay the entirety of the assessment for all of the built and unbuilt units that they have control of or own. So the guarantee that we had spoken about before has to be in a couple of different places by law. So for a declaration, I'm sorry, for a condominium. And so it has to be in the prospectus, that's the document that the initial document that's submitted to the division and approved by the division. It has to be in the declaration of condominiums. It has to be in the purchase contract or any written agreement between the developer and non-developer owners. And it may provide that after the initial guarantee period, the developer may extend the guarantee for one or more stated periods. And that's just to give the developer a buffer. You know, if the project doesn't sell as fast as they wanted to, or it's not as successful as they want to, they can set forth in those additional documents, those initial documents, that the guarantee period, their deficit funding period, can be extended out for several periods to make sure that they're not paying the I guess full assessments at that point in time. And then the financial reporting that is done has to segregate what monies were received from the developer from that of the non-developer unit owner. So it has to be really clear in the financials that are being kept, what money came from non-developer unit owners and then what money was paid by the developer. And again, the developer at that point in time is generally going to pay whatever else is needed to keep the project moving to deficit funding. Not to keep the project moving, but to keep the amenities well maintained. Prior to turnover, association funds should only be used for association purposes and may not be used for purposes of the developer. So when I misspoke just a few minutes ago, I said that I said that it's got to be clear what the developer's spending to keep the project moving, and that's they can't use association funds to keep the project moving. The association funds have to be used prior to turnover specifically, and even after turnover, have to be used specifically for maintenance of the facilities, maintenance of the association property, or other association purposes. The developer can't take, prior to turnover, the developer can't take association funds. Those are funds paid by non-developer, either unit or parcel owners, and use those for sales or promotional activities. They can't use those for construction activities to build, and they can't use them these assessments to make repairs that are under the warranty obligations. So if you've got repair work that's needed on the building, before turnover, it's improper for the association funds to be utilized to make those repairs. So those repairs have to come from developer funds. You also have to delegate out, personnel. So if you have association personnel they have to be working for the association and not for the developer. The developer can't use association funds, for administrative expenses or to, pay somebody that has maybe a dual job for both the association and the developer. It doesn't mean that you can't have somebody that wears two hats. Where they have maybe an administrative function for the developer and also an administrative function for the association, but they've got to delegate those payments, from the developer, for the developer portion of the hat that person wears, and association funds for the association hat that person might wear. All right, so we're going to talk a little bit more about reserve funding, and so. What I had said before about reserve funding is that with an HOA, you actually have to establish reserves. So there's nothing in the statute, for instance, that requires an HOA to have a reserve fund. The declaration, may require a reserve fund, or there may be a vote that establishes a reserve fund. But the general rule is that in an HOA, there's not a reserve fund. Condos, the statute requires a reserve fund unless a majority of the unit owners opt out of the reserve. And so that's important because, as the developer controls the association, they're going to opt out of the reserve fund because they're not going to want to fund future maintenance, essentially. And so whenever it gets to a situation where the majority of the board turnover is controlled by the non-developer unit owners, that's one of the first things that the board typically does, is make sure that that reserve fund gets started. Same thing in an HOA. So these are some of the most important things when you first get on a board as the first board after turnover, is to figure out if you're going to reserve and how you're going to reserve. So, for instance, it says here that in an HOA situation, reserve funding may be automatically established by the declaration, or developer may establish reserves at a pre-meeting turnover. That's probably unlikely. Because, like I said, the developer doesn't want to have to pay for maintenance that needs to be done post-turnover. And so, and since it's not automatic, since reserve funding is not automatic, it's really important in the HOA context to start reserve funding. Likewise, in a condominium association, you're probably going to have, a vote to waive reserves for the developer, but pursuant to statute, under a condominium, unless a majority of the unit owners don't want or vote to waive reserve funding, you're gonna have to reserve fund at some point in the future. And I see this being an issue, I guess fairly frequently or fairly common, in which there's just not any reserve funding because the condo board didn't know that they had to do that. And so, it says that after the first 2 fiscal years, reserves may be waived or reduced only by a vote of a majority of all the voting interests at a duly noticed member meeting. And so after 2 fiscal years, if there's not a waiver of reserves that was voted on at that point in time, that means that the association should start reserving, the condo association. All right, so what to do if you need to recall a board member pre-turnover. And so let's think about this conceptually in a situation in which you have both developer and non-developer board members, but not a majority, meaning a turnover hasn't happened yet. Okay. And so this pre-turnover board member recalls essentially allows, let's talk about the developer first, allows the developer to hold a vote to remove the board members that were appointed by the developer. And so, why would that happen? I mean, that typically wouldn't happen because typically the board members that are appointed by the developer, are, acting exactly as the developer wants. If a board member were to go rogue, for lack of a better term, on a developer that was appointed, so a developer appointed board member just wasn't, either present, got fired, whatever the situation is, that developer then has to establish a quorum, has to call a meeting and establish a quorum just from their just from the developer units. Own units, and then just the developer units get to vote on recall of that board member and presumably reappointment of someone. Same thing with non-developer board members. So the non-developer board members don't have any say as to who the developer appointed board members are. They don't have any say in recall of the developer appointed board members. So just like in the developer situation, if the non-developer unit owners want to recall one of their board members that they had elected, and we're talking about in a condominium where you got a third of the members, before turnover, or, in HOA where you've got your one board member that you got elected. If the non-developer unit owners want to recall that person, they have to call a meeting. They have to have a quorum just of the non-developer unit owners, and then they have to vote to remove that non-developer unit owner. So this probably doesn't come up a whole lot because if it's a situation where the developer wants to remove somebody, it's probably because the board member is no longer with the developer, been fired, or whatever the situation is. As far as a non-developer situation, I don't know if I've ever seen a non-developer recall. At that point, you don't really have much control anyway, so you've only got 1/3 of the board, so I don't know what good it does to recall anybody. But if there's a board member that's taken some action that the non-developer unit owners are against or don't want, then the non-developer unit owners prior to turnover do have the ability to recall that board member. And so we had already we'd already gone over all this. The only thing I really didn't say here is that when you have that vote of either the developer or the non-developer interest, I'm sorry, we have a vote of the non-developer interest, you got to have a majority of the quorum. So you have to have a quorum present, and then a majority of the quorum has to vote to remove the member. All right, so the turnover meeting, and hopefully you'll have a significant discussion prior to the turnover meeting, and so you'll have an idea about who wants to be a board member. You'll have hopefully some idea, and hopefully there won't be a lot of there may or may not be a lot of people that are vying for those positions. But if you're looking to get on that initial board, you're going to want to probably have some conversations with at least a CAM prior to becoming a board member. Now, you're not going to have any ability or authority to pay anybody at this point in time because you're not a board member. But I'm sure the CAMs on the call here would want to know as soon as possible that they're going to potentially have a project, and you can hit the ground running. You might even be able to have some proposals and things of that nature as soon as you get elected. So the election meeting for the first board is the same process that you have for an annual meeting. The developer may call the first annual meeting to ensure that turnover occurs. They may not. Sometimes the developers, for lack of a better term, check out, whether it's a successful project or not. So if it's a successful project, they may just kind of check out because they don't want to expend any more time, which is money for them, to comply with turnover. And they may leave that first turnover meeting for the non-developer unit owners. Generally, they do call that first meeting, but I'm not certain if they do everything that they're required to do generally, per turnover. So you get it noticed just like you would any other annual meeting. The process between how the vote goes is actually pretty substantially different between an HOA, or a condo. And I won't go through exactly, the timeframes and things of that nature and notice requirements that have to be given. But at that first election meeting, there should be somebody there taking minutes, and then the developer's obligated to do that. But I would suggest that whoever it is that wants to be secretary, take some minutes as well. You've got to receive all the turnover documents from the developer. And then clearly include in the minutes what documents are missing. Now, that's a provision that's specifically for condominiums because the documents aren't required to be turned over at turnover for HOAs. Most of them typically are. But you should have somebody present that's going through what documents are missing, which is also a good reason to have, at least an idea about who might want to be a CAM, present. And you might even want to have an idea about what attorney the association may want to hire as well. Even though you're not able to pay anybody at this point in time, you can start making those relationships as early as possible. So, especially in the context of a condominium, you're supposed to indicate out of the list what's missing from the list. You can videotape the turnover meeting. I don't know if I necessarily recommend videotaping, meetings, because you always have in just about every association, you've got somebody there that's going to videotape everything. But this meeting, the turnover meeting, is probably a pretty good one to videotape. And so if you're planning on being a board member, or if there's a group of people that want to be on the board, somebody should get together and tape the turnover meeting, videotape it. Once the new board members are elected at the turnover meeting, then they can elect officers. And then really important is right after turnover happens, the very first thing they should do is schedule a meeting to discuss post-turnover considerations, and talk about hiring their CAM and their attorney, because right after that, turnover meeting, the board has the ability to expend funds, and so they can actually get things done at that point in time. All right, so we're going to talk a little bit about timing of the turnover documents, and then we'll talk about what documents have to be turned over. So for the HOA Act, the turnover documents have to be turned over no more than 90 days after turnover. And so some of the documents obviously are going to be bank records and things of that nature. Hopefully the developer will get that stuff over to you earlier than that. The bank records, the money, all those things typically get turned over really quickly. And then some of the other required documents trail. Condo Act, says that, and I don't think I've ever seen this happen, but the Condo Act says that on the date of turnover at the annual meeting, the developer at their expense shall turn over all the turnover documents with the exception of the financial records and statements, including an audit, which those have to be done within 90 days from turnover. So that's why, especially in the condominium side, it's so important that you do have somebody record, the meeting, and it's also important in the minutes that those minutes indicate what documents were turned over and what documents were not turned over. All right, so this is the list of turnover documents, and so we'll kind of go through these slowly because there's a lot of stuff here. Excuse me. First and foremost, all deeds to the common property have to be turned over, right? And so I'm going to talk to you about this in the concept of both the HOAs and in the concept of a condominium. Because remember, we talked earlier about a homeowners association being a different type of ownership than a condo association. And so, in a condo association, every single unit owner owns, and let's use our 500 unit example again. You own 1/500th of all the common elements, and then you own your unit generally from the drywall in. And so, in a condo association, in an HOA association, you own your lot, you own the dirt, and you own the house that's on it. And then like your amenities are going to be owned by the association. And so I think when people think about ownership, they're much more accustomed to the concept of ownership in a homeowners association. You own your house, and your homeowners association owns the amenity center. They own all the walkways. They own all of the grass. They own anything that's common property. They own the monuments when you come into, the association with the name of the community on it and everything. And so you make a payment to the association as your assessment, and the association pays to maintain the stuff it owns. Condominium is much different. So if you own one unit out of a 500 unit condominium, that means you own your drywall in your unit. And it also means you own 1/500th of the sign out front that has the condominium name on it. You own 1/500th of the amenity center, and you own the 1/500th of any common elements to the association. So this is important, really important for one reason in particular, and that's property taxes. And so a developer could transfer ownership of all of the dirt, all of the common property to, say, the homeowners association. And they don't have to have it in their own personal name or their own personal possession. And they could do that from the beginning. And as we think about it, what's the difference to the developer if it's owned by the association that they control or if it's owned by them? And taxes is probably one good reason, is who's paying the taxes on those common elements. And so the developer, though, never transfers control or transfers those deeds until turnover. And the main reason for doing that is control. It would probably be in the developer's best interest to go ahead and transfer that property over, because then they can take it off their tax roll. And at least use association funds to pay for those taxes. But it's more important for the developer to maintain control over that. So if the project goes, if the project's not successful or whatever may happen, they want to hold on to those deeds in their name for as long as possible until they're forced to turn them over. Now, it's even more important in a condominium association, because those properties that are going to be transferred, to the association, the deeds that are going to be transferred are technically owned by the individual unit owners of those properties. So whenever they transfer those deeds over, what it does is it takes that property, off of the tax roll, because they're paying taxes on it, the developer is, and you can actually apply to the property to the tax collector's office in the county in which the property is located, and have those deeds removed off of the tax roll, because those deeds are now not owned by the developer, but they're owned by the community, in their proportionate share, owned by the unit owners in the proportionate share. And so theoretically, the property appraiser could increase the unit owner's taxes to make up for the tax roll that they lost, but in practicality, they don't do that. It just evaporates off the tax roll, is what I've seen in my experience. And I don't know if any of the CAMs on the call here have seen it otherwise, but I've never seen the tax collector or the property appraiser, reassess the unit owners, for that money that they lost. So, from a perspective of the condominiums, is really important to get those, everything transferred, and to make sure that, those properties, those common properties, are removed off the tax roll. They got to provide the original declaration and certified copies of the articles of incorporation and a copy of the bylaws. Those are important, but they should all be recorded anyways. And so, that was probably something that was a lot more important, before we had such easy access to the recorded documents online. They got to provide all amendments to the governing documents. Those amendments, for the most part, should be recorded. But you may have some unrecorded amendments and things of that nature that you might need to deal with. They should provide all meeting minutes if there are any. I find that there's usually not meeting minutes. And they got to provide the books and the records of the association. And so the books and the records have a specific meaning to them in the statutes. But you got that's going to be your vendor invoices and things of that nature primarily, and your taxes and tax records, accounting records, and things like that. If there's any rules or regulations that have been adopted, then the board needs to turn those over. I had a situation recently where, a rule or regulation is exactly that. It's not a governing document. So, you can, as board members, if you believe the documents are ambiguous or not clear, you can either formally or informally adopt a rule which interprets those documents, and then, presumably you should, be as consistent as you can be with that rule, moving forward. And so, I had a situation recently where, the developer tried to sell, a project or a homeowners association that was on the river, tried to sell it, really kind of as a boating community. And their, docs indicated that they shouldn't have, the declaration indicated that they couldn't have any boats, that were visible from the street. But lots of people had small boats that they parked in their backyard. And so the, developer trying to sell houses had a policy that they had adopted, where, they had, essentially indicated that if the boat was behind a fence, even if it stuck up over the fence, that wasn't considered visible. And so it was okay to do that. Those rules were not, I guess, transferred over, provided to the first board when they got to turnover. And so when they went to enforce the visible portion of their declarations and, tell people they need to move their boats, some of the people came up with letters from the developer that said that they had adopted a rule that allowed them, to park their boats there as long as they were behind the fence. That doesn't mean that the association is necessarily bound by whatever rules or regulations were adopted by the developer, but you should at least, consider those rules, in deciding how you're going to move forward with those situations. They got to turn over all the financial records from the association. That's going to be not just your bank records and things of that nature, but that's also going to be your taxes and vendor records, records of payment and records of the assessments itself. The money, they got to turn over the association funds, all tangible property of the association. So if the association, owns gym equipment or, other tangible property, that's got to be turned over. If the association has contracts with maintenance, landscape maintenance, or, other entities, all contracts have to be turned over as well. Even contracts, that have expired, those are part of the records of the association as well. They got to provide lists and names, addresses, and phone numbers for all the contractors, subcontractors, or others that are currently doing work for the association. They got to give all insurance policies, any permits that were issued by governmental entities. So, this is going to be like stormwater management permits and things of that nature. One of the things that, doesn't get maintained most likely as it should, probably the least likely thing to be maintained as it should in either a condo association or a homeowner association, in my experiences, are the lakes, and so St. John's River Water Management District, their permits lay out some maintenance requirements that are generally ignored, to be honest with you, by most of the associations. And so you should take a look at your permits and figure out what is it that we need to do to, maintain the ponds and lakes. I'll tell you, it's more than hiring lake doctors. And lake doctors, for anyone that's going to be on a board, is just a company in town that does, algae control. And so a lot of times algae control is about the extent that a stormwater system gets maintained, even though it should be maintained at a much greater extent than that. Any warranties have to be turned over. If they have employment contracts, if there's any employees of the association, those have got to be turned over. Again, financial records, the developer board of directors all need to provide written resignations, so it's really clear that turnover happened. There should be a roster of all owners, which is for obvious reasons. And then both under the condo statute and the HOA statute, there has to be an audit of the financial records. I find that the audit is frequently excluded. And that's one of the most important documents that you could obtain. So a lot of times the developer just doesn't do the turnover audit. They don't do it because they don't want to pay for it, the CPA to do it. A lot of times they don't do it just because, like I said, it's the end of the project and they're checked out, and unless somebody forces them to provide the turnover audit, they're not going to do it. The other thing that has to happen with turnover documents is if there's any limited common element assignments. So, in a condo association, you might have some limited common elements, meaning that you might have a space like balconies, parking spaces, storage spaces that are common elements, but only certain individuals are allowed to utilize them. And so, with that, that's probably not going to be conveyed by a deed, but will probably be conveyed by an assignment. And so you need the assignments any limited common elements as well. All right. So we talked about the turnover audit, and that's one of the most important things to get, or to make sure that you get in the turnover. The association records have to be audited by a CPA for the period of time from the date of incorporation up until the date of turnover. And the turnover audit is going to ensure that all financial statements are prepared in accordance with generally accepted accounting principles, otherwise known as GAAP, and audited in accordance with generally accepted auditing standards, which is often known as GAS. The CPAs got to examine the extent necessary supporting documents and records, including cash disbursements and related paid invoices, cash receipts, and related records, to determine the developer was charged and paid the proper amount of assessments. It's often a good idea, because the turnover audit has to be prepared by the developer. A lot of times it's a good idea to hire your own independent, auditor to audit those records and ensure that you agree with the audit from the developer. The bigger the community is, the more important it is to do that, because the bigger the community is, the less that expense is going to be, per unit owner. If it's a small community, I get it. If you don't expend the funds to do your own independent audit. If it's a bigger community, I think it'd probably be prudent to do your own audit, especially if it was a project that was not wholly successful. So if it was a project that was slow developing or marginally successful project, then I think that would increase the risk that the audit was not as accurate as it could be. Or at least increase the risk that the auditor took some assumptions, to the benefit of the developer that perhaps, shouldn't have been taken. All right, and so there's also some additional documents that are required just under the condominium condominium statute, not by the HOA statute. So, the plans and specifications of the condominium buildings have to be turned over. So you're entitled to the actual plans and specs themselves. They'd be helpful if you got those for the, amenity centers and things of that nature, but the developer is not required to provide that under 720. The developer has to provide an affidavit of the developer, architect, or engineer certifying that such plans and specifications represent the actual plans utilized in construction in the condominium. So they got to certify that those are as built, that those plans and specs were not as planned, but as built. And then they've also got to provide a report under seal of an architect and engineer attesting to the required maintenance, useful life, and replacement cost of the following column and elements: roof structure, fire protection systems, elevators, HVAC, plumbing, electrical systems, pool, seawalls, pavement and parking areas, drainage systems, painting, irrigation system. And so that's essentially the first reserve study for the association. And so that would tell you, what you needed to reserve for those particular systems. But that's not the only systems that you have to reserve for. So the board can decide that they're going to reserve for additional systems in the future if they wanted to. All right, and so we've got developer contracts, pre-turnover contracts and documents. The statutes, Florida statutes, both for condominiums and for associations, are mindful of and suspect of any contracts that the board that would give the developer the opportunity to basically, make money after or bind the association to items, particularly items that would result in a profit to the developer, in the future. So, for instance, if the developer has a contract with a management company and that management company is affiliated with the developer, that's not something that the Florida statutes believes that, should bind the association, in the future. And so they've got some, provisions that help the association to ensure that the contracts that they inherit when they take over the association or the condominium, are fair and reasonable. So any grant or reservation made by any document or in any contract that has a term that's greater than 10 years prior to turnover has to be fair and reasonable. And so, if you have any of these really long-term contracts, there's got to be a fair and reasonable standard attached to that. If the contracts are not fair or reasonable, then they can be voided by the association. Condo docs essentially say the same thing, but they don't have a period of time associated with it. So even short-term contracts that are made prior to turnover have to be fair and reasonable. And so any grant or reservation made by the declaration, lease, or other document in a condominium, and any contract made by an association prior to turnover, which provides for the operation, maintenance, or management of a condominium association, has to be fair and reasonable, and may be canceled by unit owners other than the developer. So there's a void provision if those are not reasonable. Right, condo owners' cancellation of pre-turnover contracts. So the way that works is if the association operates only one condominium and turnover has already occurred, or the non-developer owners own at least 75% of the voting interest, canceling the contract must be made by at least 75% of the non-developer voting interest. If the contract is canceled and turnover has not yet occurred, the association, and this is pre-turnover, the association shall make a new contract or otherwise provide for maintenance, management, operation in lieu of the canceled obligation by majority of the vote of the non-developer voting interests. If the owners of one condominium have the right to use property in common with other condominiums and the condominiums are operated by more than one association, no contract for maintenance, management, or operation of the property serving more than one condominium may be canceled until turnover has occurred with all associations operating the condominiums. And so if you're in a situation where you've got, a multi-condominium, or you've got one condominium that has the right to use other common property with another condominium, then you have to have a situation where turnover of all the associations has to happen before you can cancel contracts that may be unreasonable, that were asserted or entered into by the developer. And so these are just some other condo pre-turnover contracts, some cancellation of existing contracts. So a pre-turnover grant or reservation made by declaration, lease or other document, or any contract which requires the association to purchase condominium property or to lease condominium property to another party shall be deemed ratified unless rejected within 18 months after turnover. So this is a good reason why you need to take a look at those contracts that are provided to you during turnover. If you've got leases or things of that nature that the board may want to cancel, they're deemed ratified within 18 months of turnover. It says this does not apply to any contract whereby persons other than the developer are granted right to use condominium property, so long as the persons are obligated to pay at a minimum a proportionate share of the costs associated with such property. So, assuming that you got a beachfront, condominium or something like that, and there was an easement that was granted to, say, a community across the street so that they could traverse across the condominium property for a fee to utilize the beach, that's not something that, you would, under the statute, that's since it's not granted to the developer, that would allow to continue to move forward and wouldn't be able to be canceled. And so this last provision here says any contract made before or after turnover that provides for the operation, maintenance, or management of a condominium association should not be in conflict with the powers and duties of the association or the rights of the unit owners. And so that just simply means that you can only contract for what you can contract for. So, operation, maintenance, and management of a condominium association, you can only provide the level of maintenance or provides operate in accordance with the declaration themselves. All right, so here's a checklist that you got for post-turnover considerations. And so one of the most important things, I think, when you finish this process, other than all of the things that are required by turnover, is to have a professional inspect the association property for potential claims against the developer. And so you're not required to do this, but it's prudent to do it. There's nothing in the statute that indicates that the associations need to make sure that their buildings were constructed properly, and that there's no construction defects or other defects with the buildings that were maintained, or that were turned over. But the last thing you want to do is figure out that you've got some construction defects in your property many years after turnover has occurred. So you can hire an engineer or a contractor to come out and tell you if the building was constructed in accordance with building code, or if there's any issues with the property. And there may be some small issues that the association decides that they're either going to make a warranty claim on, or if they're unable to get the developer to agree with them on the warranty claim, that they just pay for themselves. Or you might find that you have some really significant problems. And so both myself and other attorneys at this firm have been involved in some pretty significant construction defects litigation, and I know that I've had a case where we settled with the developer because there was some very significant defects that were discovered about 8 years after turnover. And those were condominiums that sold at generally $130,000 or so. And the settlement to make the repairs to the condominium was somewhere in the $24,000 or so per unit amount. So, sometimes the defects can be significant even if you don't see them. So they may be latent and they might not appear for many years. You've got 10 years essentially from turnover in order to bring a claim. Well, you got 4 years after discovery of the defects. But even if the defects aren't discovered in that 10 years, 10 years is the maximum amount of time that you have to bring a claim. And sometimes you do have some pretty significant construction defects that nobody really knew were there or discovered until after that 10-year period expired. And at that point, the association doesn't have any claims, whether it be for an amenity center or whether it be, for, condominium buildings. They don't have any claims against anybody, and the unit owners have to cover the cost themselves. So I highly suggest getting someone to come out there and inspect the property. You want to review your declarations for any post-turnover amendments that might be necessary. So you can review that with an attorney, see if there's any post-turnover amendments that you might want. You might want to consider obtaining your own reserve study. If it's an HOA, you're not going to get your essentially your reserve study like you get in the condominium turnover. And it's recommended that you do a new reserve study every 3 to 5 years so you can make sure that you're properly reserving. Some of the considerations for reserve funding, especially if it was waived pre-turnover, which is typically what happened, or if it was never established for an HOA, is to affirmatively elect to provide for reserves. And you also want to understand that condos must reserve for roof replacement, painting, pavement resurfacing, or any other item that has a maintenance or replacement cost over $10,000. So these reserve studies, and there's lots of companies that do them, they're really important, and it gives you, a clear path to identify, how much money you should be collecting to, to set aside essentially for a rainy day when you're going to have to replace a certain system like a roof or whatever. You want to consider you having, like we had talked before, about having your own independent CPA review the turnover audit, and you should analyze whether you want to hire additional vendors or other professional services. Probably the professional service that is not not hired or is not transferred over is your attorney, because obviously the developer is going to keep their attorney, and that contract, that relationship is not going to transfer over at turnover. You might not feel like you need an attorney early on because you don't have any collection issues or anything of that nature, but if it's a larger association, an attorney would be really helpful at the very least for getting you through the turnover process and to help out the CAMs with that as well. All right, so there's some prohibited clauses in HOA declarations, and so the developer can't ever have a provision in the declaration that gives them the unilateral ability or right to make changes to the governing documents post-turnover. Now, it can make changes post-turnover to the governing documents if they get the votes. So that's not likely to happen unless it was a failed project, because they won't have enough votes. But in a failed project, you certainly can have a situation where, post-turnover, a developer is able to amend declarations and other governing documents. Can't be a provision in an HOA declaration that prohibits the association from suing the developer. Obviously, if the developer violated any Florida law or violated the declarations, the HOA or the condo association would have the authority to bring suit against the developer. And then there's nothing that the HOA declarations can't allow a developer to cast votes that are disproportionate to the one unit, one lot, one vote concept. And so their votes are going to have to be the same as the non-residential votes. Those clauses are null and void, and those are specifically under the HOA statute. Most developers overlook the importance of proper declaration and bylaw drafting, and they're also looking at it from their perspective, how to protect the developer, not necessarily how to protect the association. And so, there's, especially right after turnover, you're going to have probably higher participation from the community than you would have else at any other time. And so that's as good a time as any to go and take a look and see if any of those documents need to be redrafted or if any amendments need to be added. So prior to turnover, any declaration, or I'm sorry, prior to turnover, any amendment to any of the governing documents has a test of reasonableness. So and that's there to prohibit the developer from unilaterally amending the governing documents in a manner that would be arbitrary or capricious or in bad faith. And so developer is going to be liable for whatever violations of law that they have, including violation of the governing documents, both to the association, its members, and any third parties. Prior to turnover, actions taken by members of the board designated by the developer are considered actions taken by the developer itself. And the developer is responsible to the association and its members for all such actions. So what that means there is if you have a situation like where the developer didn't pay the, lawn maintenance contract and left the association with a big bill, turnover. So pre-turnover, they didn't pay it, left them with a big bill that, one, should come up in the audit, but two, would specifically give a cause of action from the association to the developer for that. And then any claim against the developer alleging any or the builder. So any claim against the developer or the builder alleging a defect in design, structural elements, or construction requires that such defect be examined by a certified licensed engineer or contractor, and that's under the Condo statute. That's not a provision under the Homeowners Association statute, but it's a good idea. So, if you get somebody to come out, even if it's done in a less than formal manner, whether it be a general contractor or engineer or otherwise, and they say, you've got some potential issues with your building, you should probably look at it, more thoroughly. At that point in time, you want to probably hire somebody to come in and provide, a full report, like an engineer or a contractor that clearly lays out, all of the structural, mechanical, or defects in design with the project or any other problems. And if you do that under the HOA statute, if you need to file a lawsuit against the builder or developer, you've already got, all of the reasons as to why you're filing suit laid out for you. And under the condominium statute, you have to do it per statute anyways. And so the idea is that the developer, if they're being alleged to have, caused a defect or sold a property that had a defect in it, they're entitled to know exactly what that defect is. And so if you do have a situation where you have some construction defects, I recommend getting an engineer or a licensed general contractor out there to provide a report as soon as possible. Under 718, the developer actually has to provide a warranty, a 3-year warranty in most instances, as far as the building is and the buildings are concerned. There is not a statutory warranty under the there's not a statutory warranty under the HOA Act, and so your rights and such are not limited to, but you have greater rights against the builder in an HOA situation than you do against the developer. And the condominium statute tries to rectify that by requiring the developer to have specific warranties, statutory warranties. And so all of those warranties run from issuance of a certificate of occupancy. So sometimes you have a certificate of occupancy for one building before you have it at another. And so anyways, when the certificate of occupancy is issued for a building, that's when the warranty begins to run from. All right, and then one thing that's important is when you go through turnover, turnover isn't an event that leaves the owners with no further recourse. What it's intended to be is an opportunity for the board and the CAM and potentially the attorney for the association to evaluate everything that happened pre-turnover, and gives them an opportunity to challenge contracts, and to bring claims against anybody that needs to be brought at that particular time. So I mean, that's the whole purpose of turnover. It's not just collecting documents and getting the money turned over. Those are all important things because you got to do that to function on a daily basis. But really, it gives you an opportunity to really do a real in-depth look at the contracts for the association. What are the vendor contracts? Evaluate all of those. Evaluate your buildings. Evaluate the need for reserves, and make sure that you guys set up a really good game plan on how this association is going to operate post-turnover. So turnover itself doesn't affirm that the warranties have been satisfied. You're going to have to go back and make sure that you make any warranty claims and such that need to be made against the developer. And owners are not obligated to waive or release the developer from any liability. Turnover just means that the non-developer owners have complete control of the community going forward, and they're going to do with it as they wish. And hopefully, through this project that we have, or through this presentation that I've given you here today, I've given you a lot to think about as you move forward with turnover. And hopefully this PowerPoint and my presentation will help you as CAMs, as board members, to really move forward with a successful association, and make sure that your first board is a great board, and that all of the other board members that follow get to stand on the shoulders of some really good work that was done. So I appreciate it, everybody listening to me here. It's been a little bit different doing this, in a room by myself without any feedback from anybody. Used to getting to see faces and getting to, perhaps have some questions get asked, during the course of the presentation. But what I'm going to do here is see if we have any questions from anybody here, and we've got a few that I'll go ahead and answer.
Thank you, Brad. I will go ahead and jump into some of the questions. Just as a reminder, if anyone is still interested in submitting a question at this point, please feel free to do so. You will move to the upper right-hand corner of your screen and submit your question there. But for now, I am going to jump into the first one, which is, what is the most important thing to accomplish in a turnover?
So most important thing I think to accomplish in a turnover is to make sure that you get all your documents and that you're required to have. You get the money, you get the you get the money, the documents, and the deeds and the property. And the second thing I think that is really important, and so both of these things are equally critical in my mind, is to make sure that you don't have any issues with the buildings themselves. So if there was any, and I talked about getting your own audit, that can be prudent. Getting your own reserve study, instead of utilizing essentially the document provided by the condo association. Those are important, but even more important than that is having an engineer or a general contractor come out and evaluate. Having a general contractor come out and evaluate the buildings themselves.
Yes, perfect. This next question, it did come in a handful of times over the course of the presentation, and it is, what if the developer will not complete the turnover?
So if the developer won't complete the turnover, then I think what you really, the best way to deal with that is to try to figure out what it is that is not being turned over, or what portion of the turnover requirements are they not complying with. Because, when you're talking about what your remedies are, you clearly have the remedy to file suit against the association, for any non-compliance, with the document. But, the question is, really, do you want to go through that expense, for whatever item it is that is missing? If they're not providing, their audit, that's a really big deal. You should, force them to do that. And in most circumstances, I would say to file suit with that. If they haven't produced, like one of the vendor contracts or something of that nature, I mean, you just gotta have to take it, step by step and see, how much effort it's gonna take to get whatever it is that's deficient, versus what you're likely to, obtain.
Okay, thank you. Here's another question that I saw a couple of times in a variety of capacities. It is, if the developer stops deficit funding, are they obligated to pay assessments on unbuilt units?
Yes, they are. I mean, that's a condominium specific question. And so the concept of phantom units that we'd spoken about before, if they're not deficit funding, then they're obligated to pay assessments for all of their units, whether built or unbuilt.
Okay. Let's see. Here's one. Prior to turnover, can the developer use association funds to fund warranty repairs?
No. And so the developers got to keep the developer money and the association money separate. And so the developer has, especially in the condominium association, the developer has, statutory warranties. They have an obligation to make those repairs, but even in the homeowners association setting, they shouldn't be using money that was received from non-developer owners to make repairs to either common elements or, buildings in a condominium.
Great, thank you. Another popular question today was, should we reserve if the developer did not?
Sorry, what was the question again?
Should we reserve if developer did not?
Yeah, so reserve funds, I think, is what
yes.
I mean there. So should you set up a reserve fund? I mean, the answer to that question is probably yes. I mean, every association is going to have to decide themselves what they want to do with that. If you don't, set up a reserve fund, then that means that you don't have, really, I look at it as a rainy day fund. You don't have a rainy day fund, for those systems when and if they need to be repaired. If you're got a board that in their general fund, they have set aside money to do that, and they're, then perhaps, you can kind of reserve yourself within the general fund. And so the pro for doing it that way is that, you don't, is that you can spend the money however you want to. You're not limited. I guess you could also set aside that you're just going to specially assess if you need to make some repairs, but special assessments aren't ever popular. One, and even if you get them passed, you may not collect on everybody, and there might be some work trying to get collection on that. The con with setting up a reserve fund is that the money can only be used, as reserved, for those specific reserve purposes. But and I've been a board member myself, in the community that I live in. And so I always thought of it as, if I thought something was a good idea, I want to make sure that, boards behind me, are obligated to move forward with that as well. And so a reserve is one way to do that. So if you're collecting reserve funds, then you're locking in future boards. And even if your current board, felt that they were disciplined enough to, save in their general funds to, pay for whatever systems might need to be resolved in the future, I wouldn't assume that, boards in the future would be equally as disciplined.
Great, thank you. The last question that I'm seeing is quite relative to the current climate. One person asked if COVID-19 has changed the analysis for developers allowing homeowners on the board of directors. So, what sort of impacts have you seen in this nature?
Yeah, so No, COVID doesn't really change the analysis for allowing homeowners on the board of directors. So, I mean, you've got to be allowed on the board of directors, when you reach those, certain milestones as far as sales of either units or, homes. But, where COVID does kind of change the analysis is how people interact with each other and how the, board may interact. So, I think under COVID changes, or not code changes, but just under COVID, the possibility of pushing forward with, virtual meetings and things of that nature, although it hasn't necessarily been addressed as of yet, is something that I know a lot of boards are currently doing now. And I expect, that we're not going to move back from that. So, I wouldn't be surprised if a lot of boards want to continue on with, virtual meetings and things of that nature. And we'll probably get some, clarification as we move forward with this about, what the limits are as far as doing things virtually versus in person. But I do think that's where COVID changes are going to go.
Okay, perfect. It looks like that is taking us to the end of our questions. So thank you, Brad, for guiding us through this today. If you guys would like to reach out or connect directly, all of our information, including Brad's, is available at jimersonfirm.com. You are also always more than welcome to give us a call at 904-389-0050. Then, as always, if you have any feedback on today's presentation, please feel free to send it to us via the link that you will receive as a follow-up to this event. And we appreciate your attendance and hope that you all have a great rest of your week. Thanks,
hey, Elizabeth, one question I have for you is a copy of this presentation going to be put up on our website, or, can a copy of the presentation be made available to anybody that requests it? What do we usually do with these?
A copy of this presentation will be emailed to everyone in a follow-up email. It will also be added to our YouTube page, which is a great resource for anyone looking for similar videos. It is the Jimerson Burr YouTube page.
Great, and I just wanted to add to that before I close out here, and I appreciate everybody that was on the webinar today. And from the perspective of the CAMs, I mean, you guys, as y'all obtain new clients, we'll probably be able to use this as a pretty good tool, for both a checklist and just how to move forward. I mean, obviously, things do change from time to time, year to year, but the turnover process has been relatively stable over the last, few years or so. But feel free to, provide this to, any other your CAMs in your office, or to any boards that may, want it. And as board members, obviously, feel free to utilize this presentation if you're going through turnover, and feel free to drop us an email or a call if you have any further questions.
Perfect, great. Thank you, Brad, and thank you everyone for joining us today. We hope you all have a great afternoon.
Thanks, everybody.